The infinite banking concept refers to a process by which an individual becomes his or her own bank. The infinite banking concept, IBC, was created by Nelson Nash. In his book, Becoming Your Own Banker, Nash talks about the use of whole life insurance policies that distribute dividends, and how owning such policies allows individuals to dictate the cash flow in their lives by borrowing against themselves instead of depending on banks or lenders for loans. In the infinite banking concept, the cash surrender value of whole life insurance policies act as collateral for a loan. The individual simply needs to call the insurance company and ask to take out a policy loan. A whole life insurance policy is meant to cover the entirety of an individual's life, not simply to assist family in the event of the individual's death. As such, the policy is eligible to pay out dividends, meaning it generates a form of income that increases the cash value of the policy over time. As soon as the policy is active, it possesses value and can be borrowed against so that the individual can take money out of the policy as a loan. The policy is used as collateral for the loan to use for handling unexpected or significant expenses that occur during the individual's life. So then how do you actually set up infinite banking for yourself? First, you should start young, while premium payments are lower. Second, choose a good insurer who isn't likely to go bankrupt anytime soon. Third, choose a non-direct recognition policy. This pays you dividends on the full cash value, even if you borrowed against it. Fourth, choose a policy with a cash value rider that benefits your loved ones. Fifth, add a paid-up additional rider, which will help you build a significant cash value faster so you can borrow more. Sixth, borrow from your whole life insurance policy. You just have to call your insurer. Lastly, pay yourself back. It's a loan, so you have to pay back to your policy, but you can take as long as you'd like. The positive aspect of the infinite banking concept is a sheer improvement in liquidity or cash flow. The value of a whole life insurance policy acts as collateral is far more liquid than equity in real estate. This is because the loan can be taken out more quickly and you can secure cash faster and usually at lower rates than traditional lenders. The improvement to a person's cash flow can be significant, especially in times of financial hardship or unforeseen expenses. Because whole life insurance policies are a non-correlated asset, they're set to retain their worth. But of course, there are disadvantages to the infinite banking concept. An individual must qualify for a whole life insurance policy. And even if they do, the financial burden that often comes with paying for the policy can be heavy. It's common and recommended for an individual to put at least 10% of their regular income into their whole life policy. If the policyholder should fall upon hard times and take out a loan against their policy, they run the risk of being unable to make adequate payments on it later on. But in the end, the infinite banking concept isn't for individuals without financial conviction and the ability to think clearly and see the process through into the future. The infinite banking concept requires an individual who's financially sound and who is willing and able to make a long-term financial commitment. It's important to consider all of the factors before becoming your own banker. So what are your thoughts? Do you need money right now or in the future? Comment below. And as always, take care of your money.